I discussed high dividend yield stocks in one of the videos in this channel. So this time around, I want to talk about how to identify undervalued high dividend yield stocks, for smart investing. How do you identify high dividend yield stocks that are at the same time undervalued? I think it's a little bit difficult. It's a difficult task actually, but yet it can still be done. If you follow the content of this video critically. Number one is look for high dividend yields relative to peers. You look for high dividend yield relative to other stocks in the same sector or industry. So compare the dividend yield of a stock to other companies in the same industry or sector. A higher yield relative to its peers may indicate the stock is undervalued, provided the company's fundamental supports the dividend payouts. That is it. If the fundamental supports the dividend payout, good and fine. It shows the stock is undervalued and it's a good buy. Number two is examine the payout ratio. Examine the dividend payout ratio. So a sustainable payout ratio, that is the percentage of earnings paid out as dividends. That's what is called payout ratio. If the company's earning is $1 billion and it pays out, let's say, $100 million as dividends, the payout ratio there is 10%. All right, so it's a percentage of the company's earning that is paid out as dividends. And so this is crucial for determining whether the dividend yield is reliable. So a payout ratio above 70% could indicate that the company is stretching its earning to maintain the dividends. A low payout ratio suggests that the company has room to maintain or increase its dividends. So the company must not overstretch its earning to pay dividends. It should pay something that the fundamentals could really support. The company performance could actually support something sustainable. Number two is that assess earnings and cash flow stability. Assess earnings and cash flow stability. So evaluate the company's ability to generate consistent earnings and cash flow. What is the probability that the company will keep on generating consistent earnings as well as cash flow along the line. So a company with a stable earnings and a strong cash flow is more likely to maintain or increase its dividends, making it a good candidate for undervaluation. So look for companies with a history of steady or growing earnings, which supports the sustainability of dividends. Is the earning increasing year in, year out? So if there's an increase in earnings year in, year out, it means the company will be able to support regular payments of dividends. Number four, so review valuation metrics. You review valuation metrics. And so as traditional valuation metrics, like you may use traditional common metrics like price to earning ratios, price to book ratios, and price to sell ratios to identify undervalued stocks. A low PE ratio, usually when compared to its peers, the company's peers in the same sector or industry will then indicate undervaluation. Similarly, a strong trading below its book value may also indicate it is undervalued. A stock that is trading below its book value may indicate that the company involved is undervalued. So, in other words, a low price to book, a low price to book value The price is the company current price. The book value is the net assets. The net assets. By the time you divide the two, you get a value. So that is what price to book is all about. So a low price to book is very important. It's an important determinant of the stock. The price is and the stock concern is undervalued. Number 5 is check for dividend growth history. Check for dividend growth history. So companies that consistently grow their dividends over time are often undervalued. When a market sentiment is negative or the stock price has fallen due to temporary factors. So look for stocks with a history of increasing dividends year after year, which suggests financial stability and commitment to returning value to shareholders. Company that pays dividend regularly, year in, year out, it shows that yes, they have their shareholders at heart and they want to return value or cash to their shareholders. That should be a very good company. All right. Please like this video and subscribe to this channel. That will motivate me to keep on bringing contents of this nature to you. Number 6 is look for a margin of safety. Look for a margin of safety. It's a very, very important. It's a very important keyword when it comes to investing. Margin of safety. So a margin of safety involves purchasing stocks at a price below the intrinsic value. But the lower the margin of safety, the higher the margin of safety, the better. If you can buy a stock far lower than its intrinsic value, you always do better. So if a high dividends yield stock, is priced significantly below its intrinsic value based on discounted cash flow analysis or other valuation methods, it may present an undervaluation opportunity. An opportunity you should not neglect. Number 7 is analyze debt level. Analyze debt levels. Analyze debt levels. In Nigeria, we call it debt. Debt levels. So companies with lower levels of debt are less risky when it comes to maintaining dividends. So the lower the amount of debt a company carries in its balance sheet, the more its ability to do what? To meet up its obligation when it comes to dividend payments. So higher level of debt can limit a company's ability to pay dividends, especially in times of economic uncertainty or downturn. So look for companies with manageable debt to equity ratios and strong credit ratings, as they are better positioned to weather downturns and sustain their dividends. When the debt is very low compared to the company's equity, a company with that level of fortress balance sheet should be able to pay dividend regularly. Number 8, monitor economic and market condition. Monitor economic and market condition. So, a broader market and economic conditions can impact the valuation of high dividend yield stocks. For example, interest rates, inflation, and industry-specific challenges can influence stock prices. So pay attention to macroeconomic trends, to assess whether a high dividend yield stock is undervalued due to its temporary external factors rather than company-specific issues. So the undervaluation, is it caused by a temporary factor, maybe in the economy, maybe in the sector, or is it a company-specific issue? And is it a long-standing matter, or is it a temporary matter? You determine that. So number 9, use screening tools. You could utilize screening tools to determine whether a high dividend yield stock is undervalued or not. So leverage stock screening tools to filter for high dividend yield stocks with low PE ratios. That's where stock screeners coming. I have videos on stock screeners in the channel. You could go and watch how to properly screen stocks that will meet your criteria for investments. So, you are expected to use stock screens that will lead you to high dividend yield stocks. Stocks with lower PE ratios, manageable payout ratios, and stable earnings. So many financial platforms and brokerage accounts offer filters to help identify undervalued dividend stocks based on specific criteria. So identifying undervalued, high dividend yield stocks requires a combination of evaluating, a combination of you consider the financial health, you use proper valuation metrics, and you also assess the sustainability of the dividend payouts. So by focusing on companies with strong fundamentals and attractive valuation, investors can find opportunities for steady income as well as long-term growth. So if you can find an undervalued, high dividend paying stocks, please, you can go ahead and buy, because you have regular income, there's potential for growth, and then you are buying an undervalued opportunity. Right.